Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and tonight we are going to go through my personal property portfolio. I'll give you a summary of where the portfolio currently sits as of today. We'll then do a deep dive. I'll give you a bit of a backstory of how I've got to where I am today, and then I'll give you a forecast based off my beliefs of where the market is heading based off the 18-year land cycle, how I look to navigate the cycle moving forward through the current land boom, and how I look to navigate the portfolio through the next land driven downturn, which is due post 2026. So stay tuned. Firstly, a summary. So the current portfolio as it stands today consists of 17 residential properties across New South Wales, Victoria, and Queensland. Total value approximately 7 million, carrying about 3.2 million in debt. So that's about a 45%, 50% gearing ratio or debt to value ratio, and generates about 350,000 per year in annual rent. So bit of a backstory. Um, when I first went to the bank in 2017, the bank would only lend me 400,000, and at the time I was fixated on buying a house. So 400,000 wouldn't have got me a one-bedroom unit in Sydney. At the time, I was looking around the inner west of where I grew up around Drummoyne. So off I went to the Hunter Valley to buy this place. It was when I first purchased it a bit of a cracked den. There was many needles throughout the house. It had not much of a bathroom at all. Kitchen was pretty rough and ready. It was very rough around the edges and needed a lot of love. So my initial plan was, because I could only borrow 400,000 from the bank, my initial plan was to buy a property, renovate it, and sell it and flip it. Do that a couple of times in the Hunter Valley to build up enough cash to then put that cash together to then buy a house in Sydney. So I renovated the property myself, and this is what the property then looked like um, after. So painted the whole place inside out, new gutters, windows, new bathroom, kitchen throughout. And at the time I went to sell it in 2018, it was right in the midst of the credit crunch that APRA uh, put on the market and restricted lending. This created a um, a significant slowdown for about 18 months in the market. So when I went to sell it at the time, I couldn't get um, initially went to sell it for about 450 mark, didn't have much interest, and then eventually had a contract drawn up for 350,000. But I was pretty much at that point going to give it away and only make circa 50,000 once I paid the capital gains tax, because I was all in for 280,000 after the $40,000 renovation. And it came down to the point where we exchanged contracts and it was subject to a pest and building. And they ended up pulling out of the contract because I didn't have a waterproofing certificate to provide them. And they wanted a warranty for the new bathroom that I put in, because I essentially went to Bunnings and got a bucket of waterproofing um, material and did the whole bathroom renovation myself, along with my girlfriend, who's now my wife. also helped me renovate the place at the time. So they end up pulling out of the contract, and at the time it was really bad negative media on the news. The market was in a well and truly set downturn. It was not the right time to be selling a property. So at the time, the real estate agent that I had looking to sell it for me said, "Why don't you put it on the market for rent and wait until the market turns and then sell it in a rising market?" So I thought that was a great idea. I ended up renting it out at the time for around the 380, $400 a week mark. And after a few months, I then realized that the rental income was then servicing the holding costs. So the interest, the maintenance upkeep rates, management costs, insurance was all getting covered by the rental income. And I had a modest $50 a week profit. And I thought that was pretty good. So after a a year or two, I then realized that you could actually refinance the loan on the property and draw equity out. So I got my deposit money plus the renovation dollars I invested into the property. I got that money debited back into my account and increased the loan. And then I used that money as a deposit and closing costs for the next purchase. So this single property that I nearly sold and let go is the sole property that was built the foundation of my portfolio today of 17 properties across 3 different states. So it was almost a blessing in disguise that I didn't sell the property at that time, and it was a slump or a downturn in the market, because I wouldn't have educated myself to understand that there's actually a better way to invest in property, and that is a buy and hold strategy, and not flipping, not buying, renovating, flipping, because then you're always on the treadmill and you're always having to do the next deal. Rather, let the market do the heavy lifting, and then over time, you can then enjoy the fruits of your labor by refinancing the loan, drawing the equity, getting the cash out, using that to keep reinvesting into further assets, but then also use the equity discretionary, and then balance the additional loan repayments with the higher cash flow that is received from the rising rents. So as you can see now, today, the current property that I still have to this day is worth market value 7 to 750,000. It's currently renting for $600 a week. That's 11+% rental yield, or 11% return. So that modest property that I bought for only 240,000 has allowed me to essentially build a portfolio worth up to 7 million bucks from that one deal. So that's the difference between buying and flipping, or buying one and as a house of residence, to buying multiple properties and then allowing compound interest to do its thing, and allow you to grow. So I then went from that house in the Hunter Valley. I learnt my lesson. I said, I'm never going to buy something that needs so much work ever again, because you're better off letting the market do the heavy lifting and buy properties that are tenant ready. So I pulled the money out of the first property and then used that to buy property number two, which is a 2-bedroom house in regional New South Wales. I bought that property in March of 2019 for 230,000. Market value today, properties are going for similar in the same town for the 550 grand mark. It's currently rented for $400 a week. So that's providing a 9% plus rental yield. So good, strong return. This property didn't really need anything done. I actually got a depreciation report done for it as well, for the kitchen and bathroom that was renovated by the previous owner. So that provided about $50,000 total value from that I depreciate over a 25, 30-year period. So that can also help to reduce the tax I pay on this property as well. And this is a double brick gun barrel house with a dual lane access. So it's got a back lane. Currently now, it doesn't comply with planning to put a granny flat, but at some point it will. The density of the town will have to increase to accommodate the growing population. So development is a long game. I've got a plan to add a granny flat for this one. The first property, I don't have the space, but this one has the physical space to build a secondary dwelling. I only will start that process at a certain point in time once the planning changes in the local area. But in the meantime, it's a very um, solid, stable investment, low maintenance, strong rental yield, solid property. Only This is only about 2 hours from Sydney as well, so good location as well. And with infrastructure going in, with new tunnels and roads and rail, over time it'll only be take a quicker amount of time to get to Sydney, less than 2 hours. So that'll also help the capital growth when infrastructure is put in between this town and Sydney. So I then had a penny drop moment from property one and property two and realized that my complete strategy had changed from looking to buy property to renovate and sell and flip to a buy and hold strategy. So I then refinanced this loan to then buy my third property, which consists of a 2-bedroom villa in Brisbane, which I bought in September 2019. Purchase price 152 grand. Current value 400 grand. It's currently rented out for $380 a week. So that's providing a 13% rental yield. So good, solid capital growth and cash flow play. So these are like throwing kindling on the fire. They're good to get into the 2-bedroom villas or townhouses or units at the early stages. And in hindsight, I would have bought this first if I knew that the strategy that I'm building now is a portfolio. I would have started with something like this rather than a house. But that's, you live and you learn. So this one was a good one. I actually bought this one at the time for such a good deal that they tried to pull out of the contract. I signed the contract exchange. They ended up getting a better offer, but because we had already exchanged, they tried to say that I paid the deposit late. And the money, yes, went into their account late, but the transaction was made on time. So I actually had to print out the transaction to prove that I didn't breach the contract. And in Brisbane, in Queensland, uh, it's typical for an initial deposit and a balance deposit to be paid. So they actually tried to pull out twice. When I paid the second deposit, they again tried to pull out. So that's a good lesson that I learned, is to make sure that you're always onto the contract. It's never a deal, it's never done deal until settlement. So you never know, especially in a rising tide, if a seller gets a better offer, they may try and pull out and claim your deposit. So it's always a good idea to never get sloppy and be onto it, and always make sure that you're doing the right thing and not breaching the contract. So paying your deposit on time, waiving the pest and building clause when it comes time, waiving the finance clause when it comes time, and not letting it lag past that, or giving an opportunity or a reason for the seller to pull out. Because when you get a good deal, most times, potentially, especially in a rising market, they might try and pull out of the deal. But this was a good another good stepping stone. I then leveraged out of this property to buy another similar property in Brisbane. This was a 2-bedroom townhouse in March 2020 for 165,000. Current value 400,000. Similar properties are now going for in the current market in the same suburbs. same suburb and surrounding suburbs, currently renting for $400 a week, providing a 12+% rental yield. So good, solid investment, both cash flow and capital growth. So at this point in time, COVID hit March 2020. I was carrying 4 properties. And when COVID originally hit around March to April, June, there was a lot of redundancies being made at the time. A lot of businesses were cutting labor force. So in preparation for a big downturn. So they were looking to obviously shore up their balance sheets to make sure that their businesses could sail through what was at the time the unknown. So I actually lost the tenant for this property and also my Hunter Valley house, regional house. So this property, I actually released it within a week, and the house in the Hunter Valley took me a month. So even though I lost half of the rental portfolio income and I went down to 50% occupied, I was still able to release the properties relatively quickly because firstly, it's a residential portfolio. It's a low risk compared to commercial, but also this is entry level properties that I like to buy. It's the affordable blue collar working class areas. It's almost classified as affordable accommodation. And what I found is even during downturns, this type of stock outperforms, even goes up in value in terms of rent and value. The reason for that is when we go through a downturn like a COVID or a GFC like event, the high end properties or even properties between $1 million to 2 or 3 million, they will have a significant pull off or correction in values and rents. But this bottom end always goes up and even goes up further in a downturn because the demand is higher for this type of stock in a downturn because mum and dad who can't hang on to $1 million loan have to sell and then potentially go rent something for a year to 2 years while they get a job or they get back on their feet when we're in a recession. So the demand for affordable accommodation rises because there's a lot of people looking to downsize into more affordable markets. So that's why I believe this type of stock, based off my experience, is the most stable and safest asset class. One of my close mates has a number of commercial properties, and during COVID, he lost 90% of his tenancies. So he went from 100% leased in 2018, 2019 down to 10% because his whole portfolio is commercial. So yes, in commercial, you will have a better return when you've got a tenant, but the risk of losing your tenant is definitely higher and the vacancy period is definitely longer. So a commercial property can be vacant for up to 3 years. So you need to keep that in mind when building a portfolio. So even myself now, being at 17 properties, I'm still wouldn't be comfortable to get into the commercial space. Not until I've got 30 or 40 properties. That's when I'd be looking to potentially get into commercial space, but not at a 4 to 5 residential portfolio because you need to have a solid foundation to support the vacancies for a protracted period of time. And residential, especially this affordable stock, is the most safest and stable way to build a portfolio. So I then leveraged out of the fourth into the fifth. Um, this is a 3 bedroom house in regional New South Wales. Bought this in June 2020. I then doubled down in June in 2020. It was the best time to buy. Most people were running for the hills, but this was the best time to buy as in the mid-cycle slowdown. Bought this one for 129,000. This is actually an ex-housing commission house. So depending on your risk profile, this could be seen as higher risk, but it has a very good strong return. So as you can see, it's worth now about 380 grand. It's renting for $350 a week. So that's a 14% plus rental yield on the original investment. So this is like a potentially higher risk in terms of it getting damaged. However, I've got this insured for 500,000. So if this got damaged or burnt down, I could claim the insurance for 500,000 to rebuild it. I probably wouldn't rebuild it though. I'd just knock it down, sell the block of land for 50, 80 grand and claim the insurance. So even the worst case scenario, it's still a good outcome. So I don't mind buying uh, ex-housing commission homes in rougher locations that back onto better areas because firstly you can get them at an extraordinary price because they've got the bad reputation. They back onto the rougher necks of the woods. So you get them for a good price. They rent out for market rate, but then when the bank looks at them, they compare them to comparable sales within a 5K radius. So if there's a house that sells around the corner or a couple of streets away for 350, 500 grand, you can use that as a comparable sale to say, well, this house is worth the same because the banks don't know that it's in a maybe a rough street or there's higher housing commission. They just look at comparable sales. So property investment is a game of finance. You got to know where to buy the properties to get them for a very good deal because you make your money on the way in and then you can refinance based off comparable sales, pull money back out and then keep reinvesting that and keep moving forward and using the cash flow to service the increased loan. So this is my fifth property. This one here has actually on a 650 square meter block, so it's even got a potential now to build a granny flat. This one though probably wouldn't do it at the present moment, doesn't quite stack up, but down the track potentially, or even knocking it and doing a duplex on this site. So it's got development upside as well. And in the meantime, it's got a cracking yield of 14 plus percent, and that's only rising every year. The rents go up 20, $30 a week. So very strong cash flow and very good capital growth. You may see that it's becoming a bit of a common theme. I then leveraged out of, I don't exactly remember exactly what property I leveraged to get into the next. I tend to leverage whatever valuation I can get now based off the bank values, based off how much debt's already on the property. So a couple of these, they're not back to back when I leverage from one to the next. It's like now a bit of a game of chess, seeing which one is in the better market that I'm refinance to move into the next loan. So today I am pretty much refinancing all the loans out of Queensland and deploying the money into Victoria, but we'll get there. I'm probably jumping ahead a bit. So this was property number 6, a 3-bedroom house, regional Queensland. This was in September 2020. Purchase price of 170,000. Current valuation 500. So this has had a extraordinary growth in such a short period of time. So more than doubled in less than 3 or 4 years based off comparable sales. Currently renting for $500 a week. So providing a 15% plus rental yield. So this is in regional Queensland. I'm on the verge of now advocating people away from regional Queensland because it's getting to the point where it's too hot. I wouldn't be buying houses for 500,000-600,000 in regional Queensland now. I think it is pretty well too expensive. There's better value to be found in Victoria and regional New South Wales and in Melbourne and in Sydney. But this is a good example of what can be found in the right market at the right time, and then what can happen when it goes through its next upturn. So I like to buy property when it's suppressed and then hold it through its upturn, refinance, and then draw the money back out and then look for the next suppressed market to then buy. So when I bought this in 2020, again, this was a suppressed market. No one was really talking up Queensland. Now everyone's talking up Queensland. But when people start talking up an area and it becomes mainstream, that is not when you want to start buying there. You want to buy in areas where no one's talking about. So good, solid investment. This one, it's a brick 3-bedroom house. This also has big block, 750 squares. I could build a granny flat at the back of this now um, as well. Haven't started plans on this. I'm working on other ones at the moment. I could also duplex this or even knock it down and build 3 or 4 units, which I'm probably going to do down the track. Instead of doing a granny flat, I'll probably just skip straight to a block of 3 units. I'm looking to get into blocks of units now moving forward. So that is another good option with the development upside. And in the meantime, it's cracking return. I actually leveraged this one most recently to buy my most recent purchase down in Victoria, which we'll get to in the coming slides. Property number 7 is a 3-bedroom house I bought in regional New South Wales. That was in December 2020. So this was the 5th purchase I did in 2020 alone. It was a very bullish, very aggressive acquisition year for me. It was the year that where everyone was running scared and not even looking at property, hence the purchase prices of all these. So this was 186,500. Couldn't get him lower. Um, Current value 440,000, renting for 20 weeks. That's 11+% return on the original purchase price. This is actually another ex-Housing Commission house, but it is a solid brick house. It's actually got a side lane which is common property, so it can it's on about a 600 square meter block or 550, 600. So this is it's a sloping block. This is can put a granny flat. I probably wouldn't develop this site to do units; it costs too much. But this is a good site. I could also add another granny flat when it comes time, when it stacks up. Property number 8 and 9 was a duplex in regional New South Wales. This is Upper Hunter, bought in April 2021. Another good deal, 270,000. Um, Currently valued 600, bringing in $605 a week in rent, providing 11% plus rental yield on the original purchase price. So this one here is two-bedroom units, very strong return, cash flow. I've actually had a DA, sent a DA in to the local council to build a third dwelling out the back. It's since been knocked back for 5 or 6 reasons. Privacy, not enough privacy, not enough open space, not enough car space, overhanging trees. I mean, there's so much legislation that has been built up over the years that they're referring to legislation that was created in the 70s, late 60s and early 70s, planning regulations. So councils are reluctant to approve development. Some councils are good, but most councils it's very tricky. So I've spent about 15 grand doing drawings, survey, um, soil testing, engineering, certifying the drawings, even paying the council 3 grand to review the damn things. All of which to get a letter saying sorry, but no thanks. So my options now are to run it to the Land and Environmental Court to overwrite the council and put it in front of the state to get them to approve it. Um, but that was probably a $40,000 or $50,000 exercise. So I am going to write a letter back to the council and explain why it's needed. It's affordable accommodation. We're currently in a rental housing crisis. Yes, it may not comply, but exemptions should be provided to provide more stock into the town. This current town has properties for rent, probably only half a dozen ever at one time. Properties for rent between $500 and $900 a week for rent, asking rents. That's more than what the asking rents are in some areas in Sydney, in Western Sydney. So this is a regional town, 3 hours from Sydney, and you've got a council that is rejecting development for affordable accommodation. It is just crazy. It's mind blowing to me. Um, it's the crux of the reason why we are in a housing crisis. You've got the local councils reluctant to approve development, that reject development, even small, modest development like this. And then you've got the federal government bringing in record numbers of wealthy migrants. When you've got a massive demand from wealthy migrants and they need places to live, and you've got local councils that are reluctant to increase supply, you've got a supply and demand issue, which is driving up rents. Higher rents then get capitalized into higher prices, and then that continues to drive the prices up. So that's what gives me confidence in always having confidence in property that's always going to keep growing, especially in an area that's got rents rising. That's a good leading indicator. Um, but I mean, it'll take time. It'll probably take maybe 10 or 15 years to get an approval. By then, it'd probably be worth just knocking it down and building 8 to 10 units on the site, and then that would then make it worthwhile to then run it through the Land and Environmental Court, and then the cost of 50, 100 grand worth of legals gets costed into the job, and then it makes it worthwhile to do it. But it's not worth running a modest granny flat or a third attachment dwelling through the Land and Environmental Court, because by the time you do it, you might as well just go and buy another property and rent it out. It's like the purpose of building affordable is to be able to build it for 160 to 180 grand. If it's going to cost 300, 400 to do the exercise, then it's not worth it. So councils don't get that though. Um, the restriction will only continue to keep driving prices. But anyway, that's a bugbear of mine, as you can probably tell. 10th property is a 3-bedroom house in Brisbane. So this is about half an hour west of Brisbane, CBD. Bought this in May 2021. Purchase price, another cracking deal, 249,000. That is absolute steal. This is on a 660 square meter block. I can build a granny flat out the back of this, but I'm looking to duplex this and just convert the house into a dual lock, because that would be cheaper and better use of the site, rather than having someone squeeze down the side access lane and not have a driveway. At some point, I'm going to try duplex this, which is probably I'm going to park the Hunter Valley DA for now. I'll write them a letter and see if they um, budge, but if not, I'll just park it and then look to engage a planner to suss this one out next. But current value 650 grand, so there's plenty of equity to also fund the build to add to convert it into a duplex. Currently rented for 480 a week, so providing a 10+% rental yield on original purchase price. So this is another good example of both cash flow and capital growth in Brisbane. Low maintenance brick asset too. Good, stable, long-term investment. I then purchased property number 11, 2-bedroom house in regional Queensland, October 2021 for 120 grand. This is on an 850 square meter block. It's currently value 300 grand. Really nothing in the town now is selling under 300, if not even 350, even 400. Like it's gone absolutely crazy. Currently renting for 330. Even that's a bit light on. I could probably push that a bit harder once the lease is up. So current rental yield 14+% on the original purchase price. This is a funny little house, this one. It's a 2 bedroom. It's almost like a granny flat. So my plan is for this one, because it's on an 800 square meter block, I'm going to build another house. It's on piers. So I'm going to build another weatherboard style Queenslander house right where that one sits. And I'm going to get a um, piling contractor or a house removalist contractor to come in and lift up this existing dwelling and push it to the back of the block, because this is almost like a granny flat, and then build a second house in the front. So a larger house that's more house proud, probably make it easier with getting it through council to say that this is going to be a larger house that's going to add to the street appeal and push this little thing back into the back half of the lot. Um, I've also purchased the house on the adjacent side, so the 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 adjacent lot is also owned by myself. So that's a strategic play as well, because at some point it would stack up to just knock all of them down and build a big block of units down the track, maybe 10 years down the track. Um, we'll get to that, but this here would be in the near future. I'm looking to start to develop these ones because the values of rising so much. There's enough equity to start funding the subdivisions and the second dwellings. I would also look to subdivide and get a second title, because if you can get a second title, then the banks can then lend on that, and it's like buying another property. So when the value of this increases like it has now, I can leverage it up to 80% of 300. So that's about 80%. So 300 times 0.8 is 240. So minus 120. So there's about, yeah, 120 grand equity. So it's not enough yet, but say once it's worth about 450, which within 2 years, I'd say 2 or 3 years, once Brisbane and Queensland really tops out, I'll then get a loan of 80%. So times zero point 0.8 is 360 minus 120. So there's a good 240,000. So once there's enough fat in or equity in this property, refinance, pull that out. In the meantime, put the DA applications through council, because that can take 2 or 3 years. Get it subdivided. Use the funds to build the second house. Once it's completed, all the loans on the front house or on the front title, and then all the second title is unencumbered. So then you can go back. Well, I'll go back to the bank and then get a loan for the unencumbered title, 80% of the value, call it 500 grand, $400,000 debit into the account, increase the loan, use that money to then go forward and keep acquiring. That was property number 11. Property number 12, same town. Bought 3 in this town, cracking town, good, strong regional hub, a lot of agriculture, a lot of investment going into the regions, a lot of people overspilling out of Brisbane and going into the regions because they can't afford in a Brisbane anymore, so they're going regions. I actually saw a stat recently of millennials it's have most highest rate of um, migrating into the regions from the metro markets, probably in search of more affordable properties, obviously. So, which is good. It's providing upward pressure of the regions. That's what's driving these regions gangbusters now, especially because they're not building enough stock. This town alone only ever has 3 or 4 rentals available at one time. Hence why the values are going crazy and the rent. So I bought this one in August 2023 for 222,000. I went up there and actually I got a builder to renovate the bathroom because the bathroom was shot. Renovated the bathroom. I painted did a bit of touch up work, did a bit of painting works, did a bit of tidying it up, leveled the house a bit, needed to plumb the drainage for the air conditioners away from the house so it wouldn't leak under the house. But spent about 30 grand just tidying it up. So I was in it for about 250 mark. Comparable sales now at that 380, 400 mark. It's renting for 450 a week, which is hence why the values are rising because the higher rents are getting capitalized into a higher price. So it's providing a 10% plus return on the original investment. Another cracking deal. This is actually a corner block, 850 or eight. I think it's about 890 squares. Corner block. This is another one I'm going to look to subdivide in the near future once the values get up and can fund the deal. So uh, as I said before, subdivide it, get the second title, leverage the existing dwelling, get the money to then fund the build, and then once it's completed, go back to the bank with the second title that's unencumbered, get a loan, and then use that to keep moving forward. So that's a good property in regional Queensland. And the third one for this town, this is the one that backs onto the other smaller 2 bedroom little granny flat looking place. So this is the opportunity to do a battle axe block as well, um, or even build a block of units across both current titles and consolidate the titles. So options are there for development upside and in the meantime it's cash flowing as well. So purchased in August 2023, 230,000, comparable sales at the $380,000 mark. So cracking deal, great purchase, even in a short period of time. Is seeing some good growth. Renting for $450 a week, so that's a 10+% rental yield on original purchase. So you may think, how does it grow so quickly in such a short period of time? How is that? Is you make your money on the purchase price. That is it. You got to make sure you get a good deal. If you overpay, you'll be waiting 10 plus years for the market to move to make any substantial equity gain. So it's all about getting a good deal. So you get a good deal, you then use comparable sales to then convince the bank it's worth more. You then refinance the loan based off the new valuations and then keep moving forward. It's the aim of the game. Do a bit of tidy up, fix them up a little bit, but I never really buy them any more that have much work other than maybe a kitchen or a bathroom or paint. Um, Pretty much tenant ready. I typically pick up the ones that need a little bit of work or have something wrong with it that needs fixing because that usually deters a lot of other buyers as well. If there's nothing wrong with it, you'll pay a premium. So I always typically buy something that needs about a 20 or 30 grand spent on it because then that deters buyers. Then you get it for 100 grand less than comparable sales. You spend the 20 or 30 grand fixing it up, or even 10 to 20 grand fixing it up. That then is capital improvements that increases the value, then it doesn't have the issues anymore, then it's then worth based off comparable sales. So I always like to buy properties that have a little something wrong with it, not nothing that needs to be knocked down and rebuilt like the first one I bought, that was too far gone, but something that has either needs it might have a leaking shower or a leaking bathroom, or it might have a dated kitchen. Like kitchens are, I don't know, 5, 6, 7 grand. You rip them out yourself and throw them in. Get a Bunnings kitchen for 3 grand if you're handy to do it yourself. If you're paying someone else, you could spend 6 to 7 grand. Um, Paint, gutters, maybe a roof. Roof leaks are really good actually. When there's a roof leak, believe it or not, quite cheap. Change a couple of roof tiles or color bond sheet, less than $1,000. Fix the ceiling, patch and paint, call it a day. A roof leak sounds really scary to most buyers, but reality is it's just general maintenance. So all properties need maintenance. So never be deterred by something that shows up in a building repair report. I use it to negotiate the purchases, purchase price further down and then fix whatever needs fixing. So that was property number 13. And this is the latest purchase that I bought down in Victoria when I went down there last month or so. Yeah, last month in May 2024. This is a block of 4 times 1 bedroom units. Cracking deal again. This is what I'm looking to buy moving forward is blocks of 3s and blocks of 4s. I'm starting to scale up now. So this purchase price 665. It's worth $1 million on paper. So even though I bought it for 665, I bought the whole block. But if I was to sell them individually, which I can because they're strata titled, I could sell them each for 250. So 250 times 4, it's $1 million. They're currently renting for 250 each per week, so that's 1,000 a week in weekly rent. So that's generating a 7.8% rental yield on day one. So once give it probably by the end of the year, if the bank plays ball that I bought it with, or they got the loan with, they may leverage it up to 80% of $1 million, so I can get my um, deposit back out plus more. I had to go into this with a 30% deposit. So blocks of units, banks typically need a high deposit. So I'll be looking to get that back plus more, leverage it up to about 800 grand. If they don't play ball, then I can easily just refinance it with another bank to keep moving forward. So this is where I'm at to as of today. What I see coming ahead is the 18-year land cycle. We're in the midst of the land boom now on the yellow marker based off history. And what I'm doing to capitalize on the final years of the boom, but also protect myself against the next land driven downturn, plus protect myself against interest rates. I see them rising from here until the peak of the market in 26, 27, and then they'll get dropped down to near zero again when the economy snaps globally. You can already see the latest data that has come out. Inflation has ticked up from 3.6% to 4% in May. So that is going to make the RBA most likely put rates up again this year. Next year, depending who wins the election in November in the States, will really impact the market differently. They have completely polar opposites when it comes to policy making. In my opinion, I think Trump will get in, and when he gets in, he's going to cut taxes to more than what was cut in the Reagan years. So taxes have never been the highest they've ever been in history in the States. He's going to cut them. He's talking down to the mid 20s from high 40s. That higher earnings that people will have will get filtered down into the benefit of land price. He's then going to drill, baby, drill. So he's looking to drill oil to reduce inflation because right now, the States is buying oil from OPEC and it's forcing the rest of the world to also buy and import oil from OPEC, and they have a monopoly, which is driving oil price up. And when oil price goes up, it pushes the cost of everything up because everything needs oil. You need transport, needs fuel, petrol prices go up. Everything is driven by energy prices. So in order to get inflation down, you need to bring oil price down, and the states will be able to do that because they've got as much oil as Saudi Arabia does, but they're not tapping into it because you've got super far left government in play, being the Biden government with Bidenomics, who's not using their resources to their full capacity. This is what's driving inflation. It's having a knock-on effect globally. Once they drill oil and drop in the cost of oil, they'll drop inflation globally, because once America cools, it'll allow the rest of the world to then cool, because they're the leading economy in the world. He'll then look to, once he gets inflation under control, to then drop interest rates. That's his plan. He wants to drop interest rates because he's got vested interest in property. Once he drops interest rates, yes, it'll bring inflation. He'll potentially bring inflation down to allow him to drop interest rates. Once he drops interest rates, he's going to set the property market on its course for the final 2 years, which will be the winner's curse. It'll be the mania years where every man and his dog talks up property. Everyone thinks they're a property spruiker. Everyone gets in at the wrong time and overpays, and then ends up potentially getting burnt when the market turns post 2026. So this is how I see it playing out. I'm going to provide more commentary on this as politics in America plays out, because it ultimately has an impact on the Australian market. How America performs will have a direct impact on the rest of the world, and very interesting times ahead, especially if a property mogul gets in at the final stages of the 18-year land cycle. It's going to be like the roaring 20s. So I'm looking to refinance and develop my property in Queensland and capitalize on the boom, to then be more exposed in Queensland by adding more stock by development, but then also reinvest the equity that I draw out into the suppressed markets of Sydney, Melbourne, regional Victoria, regional New South Wales, to then capitalize on their next 10 years, which will have good growth as of 2028 onwards. So they lead Sydney and Melbourne, New South Wales and Victoria, based off history, outperform in the recovery stage or the first half of the cycle, which is not yet to commence until 2028. And then in the second half of the cycle, Brisbane, Perth, Adelaide outperform. But right now, it's not the best time to keep buying up in Brisbane, Perth, Adelaide. It's time to develop and add stock, because you can get it in at a wholesale rate, but you want to get in when everyone's getting in. Now's the time to be buying in Sydney, Melbourne, regional Victoria, regional New South Wales, in the suppressed markets. Buy in the suppressed markets, wait until they go through the bull run, refinance, add value by renovation development, and then reinvest into the next suppressed markets. As always, this is by no means financial advice. I'm not a financial advisor. I do operate as a buyer's agent though. If this resonates with you, I'll put my details in the comments below. Hit me up. Happy to chat any day of the week about your position, your goals, your aspirations. Anyone that comes on with me and they're starting from scratch, I typically start them on a 10 property in 10-year plan, which consists of buying a couple of units or villas in a metro market, being Sydney, Melbourne, or Brisbane, leverage the growth out of them into a couple of regional houses that you can add second dwellings or granny flats, and then leverage them to buy a block of units. So 10 in 10 years is very achievable based off the strategy I've developed, based off my experience of building my 17 properties in since 2017. So what's that? Seven-ish years. So if this resonates with you and you're looking to build a portfolio, hit me up today. Happy to chat. Until next time, thanks for watching.